Hello, everybody. Thanks for joining us, me and my brother today. We appreciate all the support and everyone taking time out of their busy schedules to make it here to our webinar. We're going to do the best we can to convey this information to the community, and hopefully, you can find something useful out of it to help you and your family. Sam, any opening comments before we get started?
Welcome everyone. We appreciate everyone's support in attending today's webinar. It is greatly appreciated.
If you yourself or someone you know has ever thought to yourself or heard someone say one of the four phrases, then today's presentation is for you. I'd invest into real estate if it weren't for those price gouging contractors. Man, I'd do so many flips. I'd invest into real estate if it weren't for those pesky tenants and overcharging property maintenance companies. Man, I'd have so many rentals. I'd invest in real estate. I just don't have the time or finances for another mortgage bill. Frankly, I'm all tied up. I need more income. I'd invest into real estate if I could just put my money in, collect a check, and didn't have to manage anything. Well, I'm about to set you guys free. Welcome to the world of private lending, presented by me, myself, Paul Cafando, brother and business partner Samson Cafando, and co-host, mentor, business associate, and friend Jay Connor. Hello, Jay.
Well, hello there, Paul and Sam. I'm so excited to be here to be co-presenting this information on private money and private lending. I just first learned about private money and private lending all the way back in 2009, and it has had the biggest difference in our real estate investing career. But I'm excited to be here along with you to present this information. Anything else, Paul and Sam, before I introduce myself and get us started?
Nothing, Jay. Let's get started. Let's help these
All right.
people out.
All right, super. Well, by the way, also a thank you from me for coming on here to support Paul and Sam with this presentation. Normally, this takes, about 30 minutes or so, depending on the number of questions that we get in the presentation. So first, I'll give you a little bit of background on myself. So Jay Connor, who in the world is Jay Connor, and how is it that I'm qualified to talk about private money? Well, my wife, Carol Joy, and I, we've been investing in single-family houses here in Eastern North Carolina ever since 2003. We've been doing it a lot of years. And the first 6 years, from 2003 to 2009, all I knew to do to get funding for our deals was go to the local bank, borrow money from them, traditional money, and just use the local bank. Well, all that changed in January 2009 when the global financial crisis was going on. I lost my line of credit at the local bank. They weren't loaning money out to real estate investors anymore. And it was at that time that I learned about private money and private lending and how individuals, just like you and me, how individuals could loan money to a real estate investor, either from their investment capital or the retirement funds. And we're going to talk about some other ways as well, and be a passive investor and not have to negotiate deals, rehab houses, but just sit back and make really, really nice high rates of return. And so I learned about private money. I was able to raise $2,150,000 in less than 90 days when I first started attracting the private money. And it's all about creating win-win scenarios. We've got 47 private lenders now funding our deals. And now Paul and Sam, they are doing the business just the same way as I am by offering an opportunity to individuals to get high rates of return safely and securely, i.e. private lenders. So that's a little bit about me and my background. All right. Well, first of all, right now is a wonderful time, an excellent time to be investing in real estate, and a great time to start being a private lender. And here's the reason. Paul and Sam and I, we have got lots of ways that we find motivated sellers off market. And what that means is that their houses are not listed in the multiple listing service, but they are an off market property. So we buy directly from the owners of these homes. A lot of times these homes are distressed and do need renovation, and that's where the biggest profits are. So we're buying a lot of our houses at even less than 50 cents on the dollar, And since we buy them at deeply discounted prices, therefore we have high profits. And with the high profits, we're able to pay our private lenders. Paul and Sam, just like myself, are able to pay their private lenders high rates of return because of the profits that we are experiencing. So with that, Paul, I'm going to turn it over to you. Here is a couple of examples of properties that you and Sam have already done. So over to you, Paul.
Thanks, Jay. This deal here is something we did in our local area in Erie. As you can see, we purchased a home for 15 grand. Repairs were about 60 grand, and we sold it on a lease purchase for 135 grand. Everything funded by a local lender here in Erie. On the exit, we received a $20,000 non-refundable option deposit, plus an additional monthly cash flow of $600. Everything is maintenance and tax-free, you guys. This was an amazing deal. And with a profit split like that, we're able to pay our lender high rates of return safely and securely.
Yeah, this is a great example, Sam and Paul, of selling on rent to own or lease purchase, because when you turned around and sold it, you got a non-refundable $20,000 lease option deposit, and there's no maintenance and there's no taxes. There's no maintenance because the buyer, the rent to own buyer, is responsible for all those repairs. Here's a couple of other examples, and we won't bore you with too many examples, but we got some good examples to share here with everybody. This house here on Annneal Road, all funded with private money, a private lender, profited $80,000 on this particular deal. Here's another house, all funded with private money. This profit was over $77,000. And again, the reason we show this to you is to give you an idea as to the kinds of profits that we have on our transactions. Therefore, being able to pay our private lenders really, really high rates. So Sam, I'm going to turn it back to you to make sure everybody understands what a private lender is.
Okay, Jay, thanks. I got you. Who is a private lender? A private lender is an individual like yourself who simply loans money from their investment capital, retirement accounts, or other resources. Some people may mistake being a private lender as being a partner. This is simply not true. A private lender is someone who invests his funds to get a return hands off. This is a one-on-one transaction between an individual who is lending and an individual who will be borrowing. That is
Perfect,
who a private
Sam.
lender is.
So let's answer the question, why? What are some of the reasons as to why you would be interested in being a private lender for Sam and Paul in their business? Well, first of all, here's 4 big reasons, and there's lots of other reasons, but here's 4 big ones. First of all, you as a private lender for Sam and Paul, you're going to earn a lot of money. That normally gets the attention. So, you could put your investment capital in the local bank and a certificate of deposit, but this program is sort of similar to that. You know exactly what your rate of return is going to be, and Sam and Paul are going to go over that here in a few minutes as to actually what the interest rate is that you'll be getting. And I'll tell you, it's going to be a whole lot more than you can get in a CD at the local bank. Now, the second reason that you'd be interested in considering doing business with Sam and Paul is because there's no volatility in the value of your investment. So what I'm contrasting this program to is the stock market. If you invest in the stock market or mutual funds, you actually already lost money because you had to pay fees and commissions. And in addition to that, tomorrow or the next day after you invest in the stock market, the value of your stocks could be worth less. Well, in this program, nothing comes out of your principal loan amount. Your principal loan amount remains the same until the property is sold or cashed out. So it's just like putting the money in a CD at the bank, and you know exactly what your rate of return is going to be. It's that simple. Now, thirdly, another reason you'd be interested is we have a way that you can get your principal investment back in case of an emergency prior to the note coming due or the property being sold. And Sam and Paul will cover that in just a moment. And then in addition, your investment capital, your money is secure and it is safe. Now, we're going to explain in just a few minutes how that is, but the main thing for you to understand right now is Sam and Paul, like myself, we do not borrow unsecured funds. All the promissory notes are backed and collateralized by the property that is being purchased. So that's 4 big reasons right there as to why you want to start doing business with Sam and Paul. Now, sometimes we get this question: how is it that we can pay such high rates of return? Well, here's 4 reasons. First of all, we're buying them right, less than 50% of the after repaired value of a house. There's no middle person. There's no origination fees. Therefore, we can pay you a higher rate of return. Thirdly, we sell at full appraisal price. Well, there was an example that Sam and Paul just showed you. They sold that at full appraisal price because they sold it on a lease purchase program. That means the price is set and there's no negotiation on the price. And then fourthly, Sam and Paul are able to get their properties occupied so quickly, particularly when they sell on lease purchase. I mean, there's so many people lined up that would love to be able to have a way to own a home. They can't go to the local bank and get a mortgage. So since they get the properties occupied and get them cash flowing very, very quickly, that reduces carrying costs, increase profits, and therefore able to pay you higher rates of return. So, Sam, I'm going to turn it back over to you to answer the question: why would you and Paul be interested in doing business with private lenders instead of just going to the local bank?
Okay, Jay, thank you. Well, primarily the most attractive thing for us is that we're able to close much faster with using capital from our private lenders. There is no ceiling on the amount of deals we will be able to complete using private lenders as well. Using capital from private lenders gives us a huge advantage to negotiate more profitable deals, seeing that we can move quickly to close. In this business, as real estate investors, time is everything.
So, Sam, let's turn it over to Paul and talk about where Paul can get, or Paul can go, and where the private lenders can get funding or funds to do business with you.
Absolutely, Jay. If you pay attention to the first 4 bullet points, they're pretty much obvious. If you've got any type of liquid capital, you can use that to become a private lender. If you've got money or cash in CDs, money markets, savings account, or investment capital, literally any liquid capital, I don't care if you keep your money under the mattress, you can use that money to become a private lender. But the last 3 bullet points are some very creative ways on how you can get involved in becoming a private lender and even earn infinite rates of return. I'm going to let Jay go ahead and explain the last 3 in detail on how you can get involved in becoming a private lender by utilizing the last 3 accounts.
Thank you, Paul. So here's this first strategy that's sort of creative and that a lot of people haven't heard about. And this is called self-directed IRAs. They're also called a third-party custodian. And here's what a self-directed IRA is. What it is it's an IRA, it's a company that is approved by the IRS to be the asset manager of your retirement funds. So you can move current retirement funds over to a self-directed IRA company. And here's some different ones that we have, as an example: Quest IRA, Equity Trust Company, iPlan Group. Paul and Sam will be able to direct you as to which company to talk to. But here's the way it works. You can take existing retirement funds that you've already got, either in the stock market or it could be in a 401k from a previous employer. But if you've got current retirement funds and you're not happy with the kind of returns you're getting currently, well, you can move them over to a self-directed IRA company and it doesn't trigger any kind of taxes, any kind of penalties at all. Takes a couple of weeks typically to get it moved over. And then you can loan that money out to Paul and Sam's company, and the returns that you'll get are either tax deferred, that is the interest that you'll earn is either tax deferred or tax free, depending on the type of retirement account you've got. So the bottom line here is if you've got retirement funds and you're not happy with what's happening with those retirement funds and the returns you're getting, you definitely want to talk with Paul or Sam get introduced to one of the self-directed IRA company reps, get your questions answered. And this is the only way I know you can make unlimited money per year, either tax deferred or tax free. So, I have a lot of private lenders that are using their retirement funds to invest in our deals. And so this is definitely a strategy that you want to check out and investigate if you currently have retirement funds. Now, here's another strategy. This is called arbitrage. It's also called leveraging an asset. Now, what's really cool about this strategy of how to use equity in your home to get high rates of return. So, of course, you've probably heard of a HELOC, home equity line of credit. Well, here's the way it works. You can go to your local bank, open up a equity line of credit, and don't pull it down yet. Just have the credit line set up. And then you let Sam and Paul know how much you've got to invest from that home equity line of credit. Well, they'll find you a deal to participate in as soon as possible. And you will have told them how much you've got on that equity line of credit to invest. Well, guess what? You cannot calculate the rate of return. This is what's called an infinite rate of return. And here's why. You're making money, not on your money, but on the bank's money, because you would be loaning money out from your line of credit from the bank, and Paul and Sam would be paying you interest on that. And of course, they would pay you a higher interest rate than the interest that is being charged to you by the bank. So you get to do what the big banks do, which is called pocket the spread. So of course, Paul and Sam are going to pay you a higher rate of return than that monthly interest rate that's going back to the bank. So this is an infinite rate of return. You can't calculate it because you're loaning money out from the bank and making money. Don't you love that? So if you have got equity in real estate, you definitely want to talk with Paul or Sam about this strategy and see how you can leverage your real estate asset to actually make money on it. Now, this next idea is very similar. This is also arbitrage, leveraging an asset. So let's say you have stocks or mutual funds, and let's say you like your stocks, you like your mutual funds, and you don't want to sell them. You want to hang on to them. Well, you can leverage that asset, be a private lender with Sam and Paul, and here's the way it works. You contact your stock brokerage, and you tell them you want to open up what's called a portfolio loan account or a portfolio line of credit. You can set up a line of credit equal to up to 50% of the face value of your stocks and mutual funds. So don't pull it down, just get it set up. It normally takes a couple of weeks, and your credit score has got nothing to do with getting it set up. So once that is set up, you tell Paul and Sam how much you've got to invest from that portfolio revolving line of credit. So they'll go find you a deal to participate in. You can then pull that down, loan it out to Paul and Sam, and then guess what? They're going to pay you a higher interest rate than what your stock brokerage is charging. And all along this time, you're still owning all your stocks. Well, it's another arbitrage play. It's an infinite rate of return because now you're loaning money out from the stock brokerage to Paul and Sam and making money on the stock brokerage's money. Talk about leveraging an asset. I love it. So if you have stocks or mutual funds and you don't want to sell them, you want to keep them, you can talk with Sam and Paul about how to put this in place. And there's another arbitrage play as well that we don't have here on the PowerPoint, but that is with whole life insurance policies. So let's say you've got a whole life insurance policy. Well, guess what? You can get a revolving line of credit set up with your insurance agent, where your whole life insurance policy is. And now you can loan that money out. It's not going to affect your whole life insurance policy. And now you can use that as collateral to set up a new line of credit. You can loan that money out to Sam and Paul. They're going to pay you a higher interest rate than what the insurance company is charging. And by the way, even right today in today's market, interest rates by whole life insurance companies are super, super low. So again, there's another idea on making money on the stock brokerage's money, on the whole life insurance company's money. That's what you call leveraging an asset. Sam, I'm going to turn it back over to you for you to give an overview to everyone here as to how yours and Paul's private lending program works.
Okay, thank you, Jay. Well, first and foremost, let's start with the most attractive thing to our private lenders, which is the great rate of return that we pay out safely and securely. We are paying an interest rate of 8% to our lenders that come in at first position, and reason that being is because you are in the absolute safest position possible in the deal. You get paid first. We also pay out a rate of 10% to any lender that would be brought in second position if we needed to. And the reason we pay 10% to the lenders in second position is because the loan is usually a smaller loan, and the lender in second position would be assuming a little bit more risk than that lender in first position. But ultimately, both positions are safe. For loan to value, well, loan to value is the amount of capital we borrow versus the value of the property. We only borrow 75% of the asset's value because this is how we protect ourselves, the investors, and this is how we keep our lenders protected. We can sell at a discount and everyone's investment in the deal would still be covered. For terms, well, for liquid capital, we usually hold no longer than 2 years, and we usually allow lenders that invest their retirement account to stay in a deal for up to 5 years. We allow 5 years because people with retirement accounts usually don't need their funds back right away. And we will also like that opportunity to grow that retirement account as much as possible. But ultimately, that is up to the lender. For payments, we can pay monthly, quarterly, semi-annually, or annually. Whichever a lender prefers, it is completely up to them. Now, early withdrawals, like that 90-day call option Paul mentioned in the earlier slides, we do offer early withdrawals. All we would need is a 90-day written notice. This gives us enough time to figure out if we want to sell the property or just get you replaced with another private lender. For your minimum return, we offer a minimum return of a guaranteed 6 months interest-only payment. For a quick example, say we only borrow capital for 3 months, right, on a quick flip type of deal. This means we will be paying out a guaranteed 6 months worth of payments to you, the lender. So just imagine if we did 4 quick flips throughout the year. This means we will be getting 2 years worth of returns to our lender, guaranteed within a year's time span. I like to call this little method right here stacking returns.
All right. Great summary of the program. So moving on here. Oh, I got to get my slide going. Here we go. So how are you protected? Well, Paul, how about let everybody know how this is not an unsecured, transaction?
Absolutely, Jay. We do not borrow funds unsecured here at Bling Properties. We utilize 2 legal instruments. The first one being the deed of trust or mortgage here in Pennsylvania. And with this instrument, it legally binds the capital from the private lender to the property, and it's on public notice down at the courthouse. So everyone in the world knows you are the lender on this property, and nothing happens with the property without you being notified as the lender. Another instrument we utilize is the promissory note. And with the promissory note, it lays out the terms of the deal. It names the borrower, the lender, the 90-day call option we mentioned, as well as any other terms that we can agree upon. And that is how we protect our private lenders. They're protected just like the bank, and at closing, you receive all the necessary paperwork that will protect you, the real estate, and us, the real estate investors, in the transaction. Jay?
All right. Thank you, Paul. Well, let's go over now the documents that are used with every private lender loan closing transaction. So first of all, of course, Paul and Sam are going to have the value of the house. They'll either have an appraisal or they'll have a comparative market analysis from their realtor prepared. So even before they make an offer on the property, they're going to know what the value of that house is. And then the promissory note. Well, the promissory note simply lays out who's the lender, who's the borrower, the principal loan amount, the interest rate. Very simple document. Just lays out the terms of the note. And then the mortgage is going to collateralize that note and protect you, the lender, just like a mortgage protects a bank. And then on the insurance policy, here's another layer of protection that we give you all. And that is you, as a private lender with Paul and Sam, you'll be named on the insurance policy as the mortgagee, which means if there's ever a claim against that insurance policy, the check will actually be made payable to you and to Paul and Sam's company. What that means is you've got to sign off on that insurance policy claim check before they can cash it. And then the title policy, you are named as an additional insured on the title policy, since you would be a private lender for Paul and Sam. And that way, if there's any issues down the road with the title, then you're protected. Now, next here is very, very important, and that is the real estate attorney prepares all the closing documents and all the paperwork. Sam and Paul are not creating these closing documents. So we've got the real estate attorney preparing the documents, and that makes sure everybody is protected. So Sam, how about talk about the different ranges of investment and how you and Paul use it?
Okay. We usually use larger amount loans for purchase prices on properties, and we usually use the smaller amounts for rehabbing. If I had to put a number on a larger loan, it would probably be at least 50K per se. Keep in mind that larger amount would be used in first position, which is the most secure position you could be in. The smaller loan comes in as second position, which usually will be used for rehabbing, but ultimately both positions are safe and secure.
All right, Paul, how about tell everybody what they do with their funds and where do they send them and where do they not send them?
Absolutely. Everyone, could you please take a mental note of this slide? This is a very important slide. Please never, never, ever send your funds directly to a real estate investor. That is a red flag out of the gate. Always send your funds to the real estate attorney's trust account. If you are working with retirement funds or your third party custodian should be able to give you an actionable steps in order to get the funds to the real estate attorney's trust account. If anyone needs a real estate attorney, we work with Chris Orton out of Orton and Orton Law Firm in Northeast Erie, Pennsylvania. Very reputable company, very respectable people. If you need an introduction, please reach out to me or Sam, and I'd be happy to do that. Chris will be happy to tell you guys what it looks like becoming a private lender and how long the process takes.
Excellent, Paul. Well, let me answer this question. Are Paul and Sam concerned about market conditions or the real estate market changing and not being able to sell a house? Well, the answer is no. And the reason is because of the example that they gave you of that house when we started the presentation. And that is they're able to sell houses on lease purchase or rent to own programs. And there's always a lot more people interested in that than people being able to go to the local bank and get a mortgage. So they're buying at deeply discounted prices, just like myself. Their buyers, when they sell on lease purchase, are not shopping price. And you are secured, well secured, by a very low loan to value ratio, very conservative. And as it was pointed out, they don't borrow more than 75% of the after repaired value. Now, let's answer this question. As a private lender for Paul and Sam, do you incur any cost associated with loaning Paul and Sam funds to do a deal? And the answer is no. Paul and Sam, they pay all the closing costs to the real estate attorney. Nothing comes out of your investment capital when you do loan it. And so there's no junk fees, there's no commissions, no fees of any kind. So you know exactly what that rate of return is going to be when you invest. Now, Sam and Paul, like myself, we don't pool our private lenders' money together. In other words, we're not syndicating, we're not raising money for a fund. Every kind of transaction we do on single family houses is called one-offs. And here's what a one-off is. Paul and Sam will have a single family house, could be a duplex, triplex, quadplex, but you got one piece of real estate, and then you've got a private lender, maybe a couple of private lenders that are funding that deal. So every deal stands on its own. You got a private lender that's collateralized by a piece of property. So, Paul, let me turn it back over to you, and you can tell everybody how can they move forward and learn more specifically about how they can start doing business with you and how they can be a private lender for you.
Well, guys, if you're liking what you're hearing here today and you're interested in any capacity on becoming a private lender, all you would do is reach out to me or Sam. Tell me how much you got to invest, what kind of position you're looking to come in, what kind of rate of return you're looking to get. We'll bring you a deal, and we will schedule the closing with the attorney. We like to make this process very easy for our private lenders. Like we said, we just want you to fund the deal, put your money in, and collect the check. Easy peasy.
Exactly. Well, Paul and Sam, I'm looking in the question box. I'm not seeing any questions that were submitted.
We just had a few questions come in, Jay.
Okay.
Credit first. I'm not sure what you mean by that, Miller. Credit first.
What if you need to work on your credit first? Yeah, I don't know what that means either, because in this type of transaction, there's no credit scores pulled or whatever. Don't know. Now we got another question here. Is it hard to obtain a HELOC loan on a home of $200,000? And the answer would be no. I mean, if you've got plenty of equity in that $200,000 home, typically they will go up. The banks will typically go up to around 75% or so of the value to put up that HELOC loan. So best way to find out is, just contact your local bank that you do business with. Paul and Sam, we just got another question came in. This is from Kennedy. What is the minimum investment that you'll take?
Well, I'll let you answer this, Sam.
Minimum investment, I'd say around 20 grand. And that's enough to get a rehab done. You can invest into a rehab with 20 grand. Yeah,
I was gonna say, around here where I am, I'm most of the time I'm not gonna be able to buy a property for 20,000, but I can certainly use the 20,000 for rehabbing. Let's see here. Willie says, another question: would I be using the equity in my home to be a lender? And the answer is sort of yes and sort of no. You'd be using the equity, Willie, in your home to collateralize that home equity line of credit that you'd be setting up with the local bank. So your real estate would be the collateral to get the home equity line. But then once you get the home equity line, you loan that money out to Paul and Sam, and now you're going to be making money on the bank's money. I love this strategy.
Amazing.
All right, Sam and Paul, anything else?
Well, that's it for the day.
So here's what happens next. You definitely want to have a one-on-one conversation with Paul or Sam or both. Get your questions answered and start doing business. All right. Well, look, I want to thank Paul and Sam. Thank you again for inviting me to come along and co-present this information. All of you attendees, thank you for coming here to support Paul and Sam. Be sure and have that confidential conversation with them after we finish here. And with that, I'm wishing all of you a very profitable future by becoming Paul and Sam's next private lender. Have a good one, and bye for now.
Take care.
Take care.